Today, I'm going to talk about the awareness for the first-time real estate buyers. First of all, did you know that real estate investments create millionaires? Hi, I'm Rocky McCherney from Experience Realty. I understand how overwhelming it is to buy a property. After spending a long time in real estate and over 5 decades in the country, I can tell you that investing in real estate has always been a reliable path towards building wealth and achieving financial independence. Real estate provides physical assets, capital preservation, consistent returns, and the potential for a long-term appreciation. But for the first-time investors, this journey can seem challenging. In this video, I will address all the mentioned concerns and help the first-time investors understand Dubai's real estate market. Dubai, a city known for its modernity, luxury, and global appeal, has positioned itself as a top destination for real estate investment. The city's tax-free policies, world-class infrastructure, and growing population makes it a unique and an attractive market. Whether seeking high rental yields, steady appreciation, or a luxurious vacation home, the city offers many options to meet diverse investment goals. We are currently experiencing some incredible opportunities. It is a driven economy with a bright future and accessibility to 60% of the world GDP within 8 hours of travel time. I will also cover some more important topics when you're considering investing here, like what does your cash flow look like? How much can you invest each year? Will the investment be in line with the vision of the government and the future? Let's talk about, is Dubai real estate a bubble and where is the market headed? If you're wondering, when will the market slow down? Or are the current price levels sustainable? You're not alone. These are important questions, and to understand where the property market is heading, let's take a closer look at its journey over the years. In 2008, the property prices soared to an average of 1,950 dirhams per square feet. However, the global financial crisis caused a sharp downturn to 900 dirhams per square feet. Also during this time, Dubai's real estate market was still recovering, young, and lacked robust regulations. This contributed to the speculative practices. Following the 2008 crash, the recovery was driven by a general global economic recovery and growth. And Dubai's government introduced measures to regulate and strengthen the market. Dubai introduced stricter regulations such as the establishment of RERA, which is the Government Real Estate Regulatory Authority, to oversee developers and transactions. Escrow accounts to ensure that funds were used only for that specific project investor has paid for. Stricter penalties for project delays and fraudulent practices, enhancing investors' confidence. New mortgage caps and higher transaction fees discourage speculative buying. The market began recovering with steady increase in confidence returned. Starting in 2014, the prices reached new highs of 1,150 dirhams per square feet, influenced by Expo 2020 announcements, making a strong recovery over 5 years. From 2015 to 2019, the market entered a long phase of price stabilization that lasted 4 years, with a mix of modest growth and a flat performance, remaining at 1,150 dirhams per square feet, depending on the segment and the location. In 2020, a decline occurred due to the COVID-19 pandemic. The world had it, impacting demand globally, with prices falling to 1,000 dirhams per square feet. But from November 2020, the Dubai real estate market has experienced a consistent year-on-year growth of 15 to 25%. This 4-year surge has taken the market to a new height, creating today's peak condition of prices at 1,650 dirhams per square feet. The market recovered strongly, reaching record transaction volumes and higher prices due to investor confidence and economic recovery, driven by new government initiatives. Dubai's real estate market has cycles like any other asset, but its growth trajectory has been positive. Dubai's property sector is driven by strong fundamentals like population growth, infrastructure investment, tourism, safety, and government policies. On the demand side, the market is driven by three key segments: end users, investors, and long-term short-term tenants. Dubai's population, currently at 3.8 million, is projected to soar to 7 million by 2040, fueled by government initiatives like golden visas, 100% business ownerships, infrastructure, tax-free policies, and an economic agenda of promoting industries in tourism, technology, and green energy. The current tourist annual population of 15 million is projected to grow to 25 million annually by 2040. This works out to a requirement of 57,000 units per year. On the supply side, 30 to 35,000 new units will be delivered annually, and a steady supply pipeline is expected through 2028 due to the 4 to 5 year timeline for most developments to hand over. This demand-supply gap presents strong opportunities for both investors and homeowners. Prices are expected to climb until 2028, though certain areas may see correction by 29-30. Notably, the market is carefully regulated by government and semi-government developers, ensuring price stability and a balanced supply-demand dynamic. Dubai has shown extraordinary resilience, successfully managing global challenges such as the 2008 financial crisis and the 2020 COVID pandemic. Its ability to emerge stronger each time has cemented its reputation as a haven for both investors and residents. This resilience, coupled with its dynamic growth, continues to attract international investors, solidifying Dubai's status as a secure and a thriving real estate hub. Therefore, this real estate market in Dubai is not a bubble. Property here is still a penny stock. Next, what risks are you exposed to? Investing in real estate carries risks such as market volatility, property devaluation, fluctuating rental yields, and unforeseen maintenance costs. External factors like economic downturns, changes in government regulations, or oversupply in the market can also impact returns. To manage these risks, diversify your investments across locations or property types. Conduct thorough market research and focus on properties with strong long-term demand. Always access the developer's credibility and ensure you have a financial buffer for unexpected expenses. Additionally, seeking expert guidance and regularly reviewing your portfolio can help you mitigate potential losses and optimize returns. Dubai's land department is widely regarded as one of the most regulated and transparent in the world. Every transaction is recorded and can be easily viewed online, promoting transparency and trust in the real estate market. Next, how much return can you expect from your investment? Understanding your return on investment, which is called the ROI, and return on equity, which is called the ROE, is essential for evaluating profitability. While ROI focuses on annual rental income, ROE emphasizes on the property appreciation over time. Both metrics play a crucial role in shaping your investment strategy. Ready properties offer stability and immediate returns, while off-plan investments hold higher potential for long-term appreciation if timed correctly. The capital appreciation in off-plan ranges from 15 to 25% annually, and in a ready property, from 1 to 15% annually. Rental yields are from 5 to 8% depending on the area and the property type. Let me explain this elaborately in my next point, which is it better to buy off-plan or a ready property? Now, when considering real estate investments, the choice between ready and off-plan properties and the associated payment types, which is very crucial, which is 100% cash or 10-year mortgage in case of ready property, and 4-year 80/20 payment plan in case of off-plan property. Let's compare 5 property buying options based on these parameters and determine the optimal investment choice. I'll present a concise comparison table for clarity. While the video may not cover every detail of each column, feel free to pause and review the parameters. The parameters we'll analyze include the type of property, meaning whether it's ready or off-plan, the payment types, the areas comparison of Dubai Creek Harbour, where you may not get a good rental income like JVC of 8 to 9%, but your return on equity is substantial. For simplicity, this analysis assumes a 4-year holding period, although some options involve a 10-year mortgage. The goal is to provide a realistic picture of your return and cost over 4 years, as property would likely to be sold by then. Let's take an example where an investor has 2 million to invest across these 5 options, which include the purchase price, the land department fee of 4%, the agency commission, which is applicable to ready properties, a mortgage-related cost for options involving finance. The total costs vary depending on the payment structure and the type of property, ranging from 2.08 million to 2.16 million. Off-plan properties generally have lower upfront costs, while mortgage options include additional fees like interest and early cancellation charges. Now, in the return analysis, let's consider the potential income of sources, your rental income. While JVC offers a high rental yield of approximately 9%, making it attractive for cash flow focused investors, Creek Harbour has a rental yield of about 5%, reflecting its premium positioning. Your capital appreciation. Historically, Creek Harbour shows an appreciation of 20 to 25% annually, driven by its iconic location and alignment with Dubai's tourism and development vision. JVC's appreciation is lower, around 5%, as it's an older, more established area. Most important is your opportunity income. Off-plan properties and mortgage options allow partial liquidity during the payment period. This liquidity can generate additional income if invested elsewhere, example mutual funds, your business, etc. Now let's consider the expense which will be included, which is your service fee, which is ranging from 9 to 22 dirhams, in JVC to Creek Harbour. Your mortgage interest assumed at 4% for 4 years annually. Early mortgage cancellation fees of 1%. My result from the calculations is a net return combining rental income, capital appreciation, and the opportunity income, which ranges from 43 to 106% over 4 years. In off-plan, where you have made 100% cash payment, you still have the highest returns of 106%, primarily from your capital appreciation. While in JVC for a ready property, although it offers strong rental yields, but lower total returns of 43 to 46%. In Creek Harbour, in ready property with a balanced return of 87% from your appreciation and rental income. For mortgage buyers, you get moderate returns due to high financing costs, but still viable for investors seeking entry into the premium locations like Creek Harbour. My key takeaways: when deciding on real estate investment, consider your return metrics, which is your rental income versus your capital appreciation, your financial capability, which is very essential, whether you can manage your upfront payments, installment plans, or mortgage financing. The location potential. Iconic areas like Creek Harbour, Rashid Yacht Marina generally offer higher appreciation compared to more established areas like JVC. Ultimately, the decision depends on your investment goals, whether you want to prioritize steady cash flow or long-term capital growth. Review the table, consider these factors, and choose the option that aligns with your financial strategy. Next question: which area should you invest in? Choosing the best area to invest in depends on your unique preferences and goals. Each community offers unique advantages catering to your budget, investment opportunity, lifestyle, and the property types. For a vibrant lifestyle at a more accessible price than downtown Dubai, Dubai Creek Harbour, often referred to as Downtown 2, is an excellent choice. This community combines an energy of a city centre with futuristic design, making it a prime area for appreciation. Offering a similar vibrancy without downtown's high price tags, properties over here range between 2,200 to 2,300 compared to downtown's prices of 3,500 to 6,000 dirhams per square feet. This expansive canal pool not only enhances the aesthetic appeal of the community, but also offers numerous benefits like various water activities, promoting a vibrant and an active lifestyle for residents. Proximity to such a distinctive feature can increase property desirability and value, offering potential appreciation for investors. By integrating this remarkable canal pool, RYM elevates the standard of waterfront living, offering residents and investors a harmonious blend of luxury and long-term value. Ideal for short-term rentals, it maximizes rental income potential. Properties here are priced between 2,500 to 4,000 dirhams per square feet, while comparable areas are priced at 5,000 to 10,000 dirhams per square feet. If you're seeking long-term investment in a luxury property, Emaar Oasis is unparalleled. As their first waterfront community, it offers tranquility, vast open spaces, and luxurious mansions. This development is in the league of iconic villa communities like Emirates Hills, Dubai Hills, Jumeirah Golf Estate, Palm Jalalali, Barari, and more. While comparable communities have become unaffordable for many, with prices ranging from 4,000 to 10,000 dirhams per square feet, Emaar Oasis still starts only at 1,600 dirhams per square feet, making it a promise for long-term appreciation. For investments in townhouses or villas, consider communities like Valley, Emaar South, Villa Nova. These are new developments offering excellent value with entry price starting at 2,500 dirhams per square feet, well below similar communities like Emirates Living, Arabian Ranches, or Tilal Al Gulf. The key to a successful investment is entering the market at the right place at the right time at the right price point. Now, should you buy an apartment or a townhouse or a villa, it all comes down to your budget. If you're considering long-term rentals, townhouses and villas are often occupied by families. These tenants tend to stay longer as they prioritize stability for their families, kids attend nearby schools, they form friendships within the community and enjoy the amenities and activities in the area. This means less risk of vacancies. Additionally, maintenance costs are relatively low, averaging to 3 to 6 dirhams per square feet, making them more economical compared to apartments. Apartments are typically located closer to metro stations and have easier access to restaurants, schools, hospitals, and other transport services. While maintenance costs are higher, ranging from 10 to 50 dirhams per square feet, apartments offer flexibility in rental options. Both short-term and long-term rentals are viable, with short-term rentals often yield higher ROI compared to any long-term rental option in apartments, townhouse, or villas. Next, should you invest with established developers like Emaar, Nakheel, Miras, known for their structured payment plans and focus on long-term value and or explore options with other developers offering more flexible and less aggressive payment plans. Renowned developers strategically design their offerings which prioritize for long-term vision that attract buyers who value capital preservation and market stability over short-term. Their investors are known for their resilience and commitment, often holding on to their properties through market fluctuations rather than opting for distressed sales. By collaborating with these trusted names, investors gain access to opportunities backed by expertise with proven market leaderships, ensuring a path to sustainable and profitable returns in Dubai's ever-evolving property landscape. Now that I've addressed all the questions that a first-time investor would have in mind, are you ready to begin your real estate investment journey? Let's work together to help you make a confident and a profitable decision in this Dubai's thriving market. Contact me on the below number. Don't forget to like, subscribe to our YouTube channel for more insights. Signing off, Rakhi Mekchani, Experience Realty.